You can catch that full conversation, of course, only on ET now. Let's go across. We have Subbiah Kumar, who's waiting by, CFO at CEAT, to talk to us about all that's playing out. Mr. Kumar, great having you. Can you walk us through the segment-wise outlook in terms of growth for Q3 as well as FY26 full year across OEM, replacement, international markets? How is growth going to be spread out?
See, at an aggregate level, we would like to achieve about double-digit kind of a growth as far as FY26 is concerned. We are on track, okay, and we had a similar internal plan for the previous year, and that's what we delivered in FY25 too. So that FY25 and FY24, the growth was led by aftermarket segment. Okay, in the current year, we expect while aftermarket growth would be strong, could be in single digits, but we would like OEM business and international business, that is exports business, to grow in strong double digits. So this broad we have in mind as far as these three segments are concerned for FY26. In the first 6 months, we have grown by about 12% year on year, okay, and largely led by OEM business, followed by international business and replacements. So that's our overall plan.
Right. And what's your view on raw material prices, especially natural rubber and crude-linked imports, and how exactly do you think this could shape up margins in the second half?
Okay, raw material prices have been stable almost for the last 4 months. Natural rubber prices in India has been moving in the range of about 185 rupees per kg to 190, and international rubber prices are largely hovering around $1,700 per ton, plus or minus $50. Crude prices have been around $65, approximately in that range. So we expect Q3 raw material prices to be in line with Q2. In Q2, for us, the raw material prices went down by about 5% on a Q1 basis, and we would like it to sustain in Q3. And our outlook as far as raw material prices are concerned in the next 3-4 months is stable, okay, unless and otherwise something unusual happens.
And Mr. Kumar, how transformational is the CAMSO asset acquisition for CEAT? How are the long-term synergies that you are expecting in terms of off-highway as well as specialty tires likely to play out?
No, overall, from our own long-term strategy point of view and capital allocation point of view, passenger category, which is basically passenger car radial tires and two-wheeler tires, and off-highway tires, these are important from our standpoint. So capital allocation also, our own approach would certainly reflect in terms of allocating a higher amount of capital from the total capital to passenger category as well as from off-highway tires. It was on this logic, okay, it was decided that we would explore acquiring the brand CAMSO, and which successfully happened. CAMSO is a global player. They are in the off-highway segment, both in tracks and tires. We are currently not present in tracks, so therefore it's an addition to our existing portfolio, maybe more or less servicing a same set of customers. And second, CAMSO is perceived as a premium product, okay, in the international market. So it fits very well, one off-highway tire brand and a brand which is perceived as a premium to be part of our portfolio. So we feel it's an important milestone from our standpoint. Going into the future, one of the arrangements or conditions that we have agreed was in the next 3-year period, the brand CAMSO would be largely used only in compact construction category, the category that we have acquired from Michelin. After a 3-year period, okay, we would be able to utilize the brand CAMSO for any of our categories as we deem fit. Okay, so therefore, from our standpoint, we are quite happy with the acquisition, and we think it will add value and strategically in terms of enhancing not only the margin profile of the categories, but also in terms of growing off-highway tires.